In this video, we'll continue where we left off and we will expand more on adjusting entries. And we said that for adjusting entries, we have two types, deferrals and accruals. Deferrals are a cash transaction takes place first, and then later there's work to follow the transaction. Accruals are the opposite. There's a work transaction or an action that takes place first, and then there's a payment later. Okay, so we'll start with deferrals, and there's two types of deferrals. There's deferred expenses and there's deferred revenues, and we're going to look at each type of entry that we'll find in this scenario. So for deferred expenses, we have prepaid expenses. This is prepaid insurance and prepaid rent. Okay, so let's take a look at a scenario. So so here we have a scenario where I've got some T account. So we're going to assume that the beginning cash balance is $10,000. I just made that number up, and so the balance is 10,000. So we're starting with 10,000, and that's because I don't want a negative balance in my cash T account, right? So here we have the 3 T accounts, and then we have cash. Okay, and then we have here, this is the general journal where we'll do the record to the general journal, and you post to the journal ledger over here. Okay, so it says ABC Company purchases 12 months of insurance for $1,200. Okay, so what's going on here? They're receiving insurance and they're paying $1,200 in cash, right? So this is $1,200 in cash. Okay, so now we have that. How do we go ahead and record this journal entry, right? How do you go ahead and record it? So the first thing we need to do is you can go back to your journal entry handout and says, okay, what are we receiving? We're receiving insurance that's paid for ahead of time. So it's a prepayment of insurance, and we're paying cash. So the shortcut for these entries is to do the cash part first. If we're paying cash, cash is going down. What do we do with cash when it's going down? We credit cash. So I'm going to go over here to cash, and I know that that's going to be a credit to cash, and it's going to be for $1,200. Well, there's only 2 lines in this entry. So if I credit cash, I'm going to have to debit something else. Well, what account in my list best reflects the receipt of insurance ahead of time? Well, there's this account called prepaid insurance. It's going up, and that's going to be a debit. So I'm going to go over here and I'm going to be debit that for $1,200. So my first entry, or the cash transaction that takes place first, is a debit to prepaid insurance and a credit to cash. So over here, I'm going to put in $1,200. That's my debit. And over here, I'm going to put in $1,200. That's my credit. And now I have $8,800 left in my cash account and $1,200 in my prepaid insurance account. Okay, so debit to prepaid insurance, credit to cash on the first. Now, 1 month goes by and it's January 31st. So what happens on January 31st? What is the journal entry? And this is where some people make a mistake, because they say, okay, on January 31st, what I need to do is I need to debit cash for $1,200 or debit cash for something else. Well, on January 31st, we do not do anything to cash. Why? Because we're not paying anything. We paid for 12 months worth of insurance up here on January 1st. We're not making another payment on January 31st. What happens between January 1st and January 31st? The only thing that happens is we use insurance. And here's the key. How much insurance did we use? Did we use 12 months worth of insurance? No, we used 1 month's worth of insurance. So if $1,200 represents 12 months worth of insurance, if I take $1,200 and I divide it by 12, right? If I divide $1,200 by 12, what do I get? I get $100. Okay, I'm going to put it over here. I get $100. So every month, I am going to use up $100 worth of insurance, right? It's going to be an equal sign. I'm going to use up $100 worth of insurance every month. Okay, I'll put it up here. That's going to look a little bit better and easier for you to see. Okay, so I have $100 worth of insurance. Okay, that's used up every month. So again, what we're doing on the 31st is we're trying to capture what happened between the 1st and the 31st. What happened between the 1st and the 31st? We used up 1 month's worth of insurance. 1 month's worth of insurance is $100. How do we get that? Well, $1,200 represents 12 months. So if I take $1,200 divided by 12, 1 month's worth of insurance is going to be 1 month, okay, or $100. All right, so now what's going to happen? How do we record this entry? Well, if you look at the handout, it tells you the entry, right? We're going to debit the prepaid expense, and we're going to, sorry, no, not this entry, the adjusting entry. We're going to debit the expense, and we're going to credit the prepaid expense. So we're going to debit the expense account, and we're going to credit the prepaid account, or debit the expense account and credit the asset account. So let's explain that. So we use up 1 month's worth of insurance. So right away, what's going to happen to my prepaid insurance account? Well, this $1,200 on the debit side, this represents 12 months worth of insurance. On January 31st, guess what? I don't have 12 months worth of insurance anymore. I only have 11 months worth of insurance. So my prepaid insurance has to come down by $100. So I'm going to credit prepaid insurance for $100, okay? Because it has to come down by $100. Okay, so now notice my balance now is $1,100. Okay, this goes down. So over here, I'm going to credit prepaid insurance for $100. All right. Well, what is my debit? Well, what happened between January 1st and January 31st? I used up 1 month's worth of insurance. And whenever you use something up, that is a key word for an expense. An expense reflects the using up of something. So salary is expense. That's the using up of labor. Insurance expense is the using up of insurance. Rent expense is the using up of rent. So whenever you see a word and an expense in it, what that means is over a certain period of time, that is how much that company used up of that service. So if you see insurance expense $1 million, that means for the year or for however long, this company used up $1 million worth of insurance. So in this case, we used up $100 worth of insurance. So we're going to debit insurance expense. Okay, so over here, I'm going to put in a debit to an insurance expense for $100. And now 100, that's my answer. So in the adjusting entry, look what happens. We have an insurance expense that's debited and a prepaid insurance account that's credited. Remember, prepaid insurance is an asset account. So we credit the asset account, we debit the insurance, we debit the expense account. So the expense account increases, the asset account decreases. And one of the points I want to make here is I want you to get the relationship between the asset and the expense. So an expense in adjusting entries is using up of the asset. Our asset is prepaid insurance. Our expense is insurance expense. So notice what's happening here. This is a transformation. This asset becomes an expense when we use it up. That's very important. When the asset becomes an expense when we use it up. So a definition of expense is really the using up of an asset. That's really what it is. So when you use up an asset, that asset now becomes an expense. So this is an example of prepaid insurance. And we're going to now do another example